Welcome to Talk Tickers. Today, we're diving into the Q2 2025 earnings for Dick's Sporting Goods. And folks, this one's a real head-scratcher, a fascinating case study in how the market thinks.
Okay, so check this out. On one hand, you have the company's report, which was a classic beat and raise. That's the stuff that usually sends a stock to the moon. But on the other hand, you have the market's reaction, a punishing 5% sell-off. So, what gives? That's exactly what we're going to unpack.
First things first, let's look at the actual results because the numbers themselves paint a really clear picture. The core business is absolutely firing on all cylinders. The headline number you really need to see is this. Comparable store sales grew a very strong 5%. And that's impressive because it's building on top of 2 previous years of solid growth. They did it by getting more people through the door and by having those people spend more each time. That's the magic formula.
And as you can see right here, they just cleanly blew past what Wall Street was expecting. Earnings per share came in 8 cents above estimates, and revenue, a full $40 million ahead of what everyone thought. That is a clear beat on both the top and the bottom line, no two ways about it.
And get this, their confidence didn't just stop with the quarter. Management went ahead and raised their outlook for the entire year. We're talking higher forecasts for earnings, for sales, and for those critical comps. That signals some serious momentum in their core business.
Okay, so everything sounds amazing, right? You would think the stock would be flying high. Well, let's talk about the market's, let's call it puzzling reaction.
Despite all of that fantastic news we just went over, the stock got hammered. It closed down nearly 5% on the day of the announcement. This is the disconnect we're here to explain. And listen, this wasn't some quiet little drift downward. Just look at the trading volume on this chart. It was massive. We're talking nearly 4 times the daily average. A spike like that is a huge red flag. It tells you that the big money, the institutional investors, were heading for the exits. So if the actual business is doing so well, what on earth was driving all this selling? The answer isn't in what Dick's just reported, but in what's coming right around the corner.
It all comes down to this one question. Why sell a winner? What could possibly have the market so spooked?
And the answer, in a nutshell, is a classic Wall Street term, deal overhang. It's basically this cloud of uncertainty that hangs over a stock when a company is about to close a really big, complicated deal. And in this case, we're talking about the largest acquisition in the company's entire history.
See, the market is looking right past that great Q2 quarter and focusing on this huge mountain of risk from the Foot Locker integration. It's a massive, complex deal to turn around a struggling business, and it's set to close in just days. But you know what the biggest red flag for investors is? Management's new rosy guidance explicitly excludes Foot Locker. That's the uncertainty that's being priced into the stock right now.
So, putting it all together, what does this mean for the stock going forward? Let's get into our take on what to expect next. For us, the path forward really comes down to 3 key elements. First up, next quarter's results. We fully expect the core Dick's business to look strong again, but that's not what people are going to be listening for. All ears will be on the commentary about the Foot Locker integration costs and what it's doing to their profit margins. Next, the stock's price. Because of all this uncertainty, we see the stock as being pretty much range-bound for now. The next big catalyst will be that Q3 call. A clear, confident integration plan could unlock some serious upside, but any hint of trouble could lead to another wave of selling. And finally, this all brings us to our official rating, which has to balance this really strong core business against a massive, risky acquisition. Based on all the evidence, we're giving this a market perform rating. You just can't deny the company's excellent execution. It's fantastic. But that strength is being perfectly balanced, or you could say canceled out, by the huge integration risks from this Foot Locker deal. The real question isn't how Dick's performed last quarter. It's whether they can successfully digest the biggest acquisition in their history. And until we get more clarity on that, the stock is likely to just perform in line with the market.
This is not financial advice.